We are Group 6, presenting on the Albertsons LBO. Members of the group include
Josh Phillips, Nate Squires,
Devin Overd,
and Jackson Everton. In 1939, Albertsons opened their doors in Boise, Idaho. Since opening, Albertsons has experienced their fair share of ups and downs. In 1998, they purchased American Stores Company for just under $12 billion to help expand their storefront. In the early 2000s, Albertsons hit a rough patch in business. They began to experience what is known as the Walmart effect. This mass merchandising done by Walmart was driving the prices down and hurting Albertsons' profit margin. In 2001, Albertsons started to change their strategy to keep up with changing markets and competition. They hired Larry Johnston as the new CEO. Johnston came up with a strategy to help Albertsons succeed. His strategy included focusing on the following. He would focus on controlling costs and processes, on the return on investments, on customer service, on the technology implemented by the company, and on employee energy. By the year 2005, Albertsons was the second largest supermarket in the U.S., with 2,500 stores, 240,000 employees, and $40 billion in sales. Though they were the second largest, this wasn't enough for Albertsons. In 2005, they hired Goldman Sachs and Blackstone to look for strategic alternatives.
The participating buyers in the Albertsons LBO were SuperValue, CVS Pharmacy, Cerberus Capital Management, and the Kimco Realty Corporation. Through this LBO, they sought to achieve $150 to $175 million in synergy.
SuperValue is a U.S. grocery distributor and retailer. SuperValue is a Fortune 500 company located in Minneapolis. It has acquired well-known chains such as Shopko, Cub Foods, Rich Food Holdings, and Hornbachers over the years. SuperValue was interested in Albertsons because it would double in size through the acquisition of the Albertsons stores. The transaction would propel SuperValue to become the third largest retailer in the country, with stores in 48 different states. CVS Pharmacy is headquartered in Delaware and is the second largest pharmacy chain in the United States with 7,000 stores in 43 different states. Its main competitors are Walgreens and Walmart. CVS was interested in acquiring the freestanding Albertsons-owned pharmacies to increase their market share and move closer to its competitor Walgreens. Cerberus Capital Management is one of the world's leading private equity firms based in New York. Cerberus currently manages more than $20 billion in investor money. Cerberus investors include university endowments, insurance companies, charitable organizations, and retirement funds. They were interested in obtaining Albertsons' poor-performing stores at a discount. They also hope to generate cash by shutting down the worst-performing stores and selling the real estate. Kimco Realty is a publicly traded real estate investment trust headquartered in New York. Kimco owns and operates the largest portfolio of community shopping centers in the United States. They have interest in 727 shopping centers, comprising of 107 million square feet of leasable space. Kimco was interested in selling the underperforming Albertsons locations for the value of their real estate.
The Royal Bank of Scotland was the leader in the transaction. The total worth of the buyout was $17.4 billion. The breakdown of what was from the Royal Bank of Scotland and other sources are as follows. There was a $2 billion term loan, a $2 billion revolver loan, a $1.25 billion term A loan, and a $750 million term B loan. The rate on the pro rata was LIBOR plus 1.5%. The rate on the institutional term loan was LIBOR plus 1.75%. The syndication agents involved with the term loan consisted of many syndicates. Some of the major banks involved were Bank of America, Citigroup, and Rabobank. Apart from the leveraged funds, the buyout consisted of $2.9 billion in cash, $2.4 billion in SuperValue common stock, and the assumption of $6.1 billion of Albertsons debt. The one-day acquisition premium was 8.1%. The 1 week premium was 15.3%, and the 4 week premium was 29.9%. Albertsons stockholders were paid $20.35 in cash and 18.2% of SuperValue stock for every one stock of Albertsons they held. The value of 18.2% of SuperValue stock at the time was $5.94. This created a per share cost of $26.29.
The merger couldn't be completed without approval from shareholders of Albertsons and SuperValue. Albertsons shareholders had to approve the merger agreement, while SuperValue stockholders had to approve issuance of more SuperValue shares to fund the merger. If the agreement were terminated due to the actions of SuperValue, the company would be required to pay Albertsons a fee of $135 million. If the termination was due to some action by Albertsons, the company would be required to pay SuperValue a fee of $276 million. Cerberus would receive 15% of any fees awarded to SuperValue. In the event of termination for antitrust reasons, Cerberus and SuperValue would be required to pay $250 million to Albertsons. Cerberus would be responsible for $70 million of the $250 million termination fee imposed, and SuperValue would pay the remainder. Albertsons shareholders approved the merger on May 30th, 2006. The merger also couldn't be completed until the waiting period applicable under the Hart-Scott-Rodino Antitrust Improvement Act of 1976 expired, which it did on March 14, 2006. The deal also had to wait for approval from the New York Stock Exchange to list the shares of SuperValue that were to be issued to finance the merger. Under the acquisition method of accounting, the merger was classified as a business combination, with SuperValue listed as the acquirer and New Albertsons the acquiree. SuperValue and New Albertsons would both be responsible for all tax obligations of the core business in the periods before and after closing. Both companies also shared the income tax obligations for all periods prior to the closing. Accepting merger considerations by stockholders in exchange for shares of New Albertsons common stock would be a taxable transaction for federal income tax purposes. Any gain or loss of the shares of New Albertsons stock would be considered a long-term capital gain if the holding period, which included the holding period of Albertsons stock prior to the merger, exceeded 1 year.
Here is the income statements from years 2003 to 2005 and some other financial ratios. The income statement shows what began to happen to them since the early 2000s. As you can see, their revenues weren't growing at a constant rate. Revenues started at close to $36 billion in 2003, down to $32 billion in 2004, and then back up to $40 billion in 2005. However, the cost of goods sold were continually going up each year as a percentage of sales. This Walmart effect, which began in early 2000s, caused a down pressure on their gross profit margin, going from 29.1% in 2003 down to 28% in 2005. The EBITDA and operating revenues also felt this down pressure, and as a percentage of revenues were going down each year. This graph shows the average EBITDA multiple for each year from 2001 to 2014. The EBITDA multiple for this transaction was 7.48 times. This transaction happened in 2006, and as you can see from this graph, 7.48 times is a little below the average for that year. Even though it had a smaller EBITDA multiple than the average, when this transaction took place, it was the second largest LBO transaction at $17.4 billion.
After the LBO, SuperValue struggled to operate New Albertsons Inc., while Albertsons LLC appeared to flourish after closing 100 stores right after acquiring them. New Albertsons Inc. even began with a strong start by acquiring the remaining 8 Wyoming locations that were owned by Albertsons LLC in 2007. 6 months prior to selling the 8 Wyoming stores to New Albertsons, Albertsons LLC acquired all Rally's locations in New Mexico. Unfortunately, New Albertsons Inc. struggled to remain profitable and sold 36 Utah locations in 2009 and announced 60 store closures in 2012. On January 10, 2013, SuperValue announced that it would be selling New Albertsons to Cerberus Capital Management. In February 2014, Safeway announced that it was in negotiations to sell itself to Cerberus Capital. In March 2014, Cerberus announced that Safeway would be purchased for $9.4 billion, and in July, Safeway stockholders approved the merger with Albertsons LLC. The seemingly unstoppable Cerberus-led Albertsons suffered a minor setback in October 2015 as it attempted an IPO under the name Albertsons Companies Inc. However, the offering was postponed indefinitely, citing poor market conditions.